Pfizer is a stock that I've been covering for a while, and so far I have been wrong on my thesis on Pfizer. I saw many times that the stock was nearing an inflection point, that it would get much better from here, and so far it hasn't been the case. The stock has been flat for a while. In fact, it's down 29% over the last 5 years. It's been a terrible performance on Pfizer, but the dividend right now on Pfizer is 7%. 7% is very attractive, especially whenever interest rates are going down. A lot of the dividend stocks tend to do extremely well because their dividend yield looks extremely attractive relative to the 10-year or relative to a regular savings account or money market funds. So the 7% on Pfizer is attractive, but the question is it really sustainable? Are they going to cut the dividend, or is the dividend actually safe? And that's what I'm going to talk about in today's video, and I really hope you enjoy it as always. Now, the last report on Pfizer was actually really good. They put up 78 cents versus 58 cents expected. They also had a massive beat on revenues, so that's pretty amazing from the company. Everything was really good in terms of their report, but especially the oncology sector. I'm very bullish on oncology over the next 5 to 10 years, and I believe Pfizer is one of the key players in the space after they acquired Seagen, which was a game changer for the company, and they're still finding a lot of efficiencies and a lot of synergies as they acquired Seagen, and this segment has grown 11% over the last quarter. So that was a very good quarter for Pfizer. But not only their legacy segments have been growing extremely well, but their new segments or their recent launches and acquired products have been doing really well, and they increased 15% in revenues. And as Pfizer, BMY, and many of those pharmaceutical stocks, they're facing a patent cliff over the next 2 to 3 years, and they're acquiring and they're launching a lot of new products to offset the old products. And this is the same thing Pfizer, BMY, Merck, and a lot of them are pretty much stuck in the same boat at the same time. And guidance was very good from the company, very good on revenue guidance. They raised earnings per share guidance from $3 to $3.10. So everything was really good with the company, and the quarter was pretty amazing. Now, one reason why Pfizer hasn't been doing too well is because the company hasn't really been buying back stock. And it's really terrible whenever the company is sitting at an 11% free cash flow yield, is trading at 8 times earnings, and the company cannot buy back stock and create massive value for shareholders at 8 PE. They just can't do it. And I'm going to tell you why they can't do it. They mainly did a lot of dividends, and they grew the dividend. They did a lot of research and development to launch new products and do other things. They also deleveraged the balance sheet, but they have done zero buybacks. And the reason why they did zero buybacks is because the company had a lot of debt after they acquired Seagen, and they've been paying a lot of the debt off. They had $6 billion due in 2026, but the company this year has been paying some of it off. This is 2024 data, so now in 2025, they paid a lot of the 2026 debt, and in 2027, they only have $980 million due. So I believe we're likely near a buyback period for Pfizer, when Pfizer will remove buybacks. I've seen it with many different stocks, like British American Tobacco. The stock had a 10% dividend yield, and it was going down on no buybacks. And once buybacks were resumed, and a lot of investors believe that now there's some kind of a bid, some kind of a floor on the company, on the stock, and then the stock kind of bottomed out and is starting doing extremely well. And we could potentially have this catalyst for Pfizer going into 2026, as in 2027, they barely have $1 billion in debt due. Now, in terms of the 7% dividend, it's very attractive, and I believe the dividend is sustainable, because if you look at the free cash flow yield, the free cash flow yield is 11%. Pfizer's dividend yield is 7%, so this is like a 65-68% payout ratio on a free cash flow basis. So the dividend is very sustainable, and I believe is going to continue to be sustainable as the company is expecting to massively increase free cash flow from $12 billion in 2025 to 18.4 up to $19 billion by 2027. Now, you may be asking yourself, how will the company grow in cash flow around $6 or $7 billion if they're not really growing in revenues. And this is mainly because of a lot of savings and synergies that the company has discovered within their own business structure. And this is why they had an activist involved. There was a lot of wasteful spending within Pfizer, a lot of missed on opportunities, and the management they made a lot of mistakes, and they were overspending by around $7 billion in a lot of dumb areas. And the expected cost savings right now is $7.2 billion by the end of 2027, which is going to boost free cash flow to $18.4 billion. And the dividend right now is around 9.6. So you could say 10 billion in dividends, and free cash flow should be around $18 billion. So I believe the 7% dividend yield is safe, and it's actually extremely attractive, especially when interest rates are going down. And by the way, I'm using Fiscal.AI to come up with all those charts. So if you want to try it out, they give you 2 weeks of free access if you use my link down into the description. But for Pfizer itself, I like to normally value those stocks at a free cash flow yield plus revenue growth. If they don't have a lot of revenue growth, I look at free cash flow yield. The free cash flow yield right now is 11%. The average yield on Pfizer is around 8%, 8.5%. Now it's way above the average. So you could potentially get a multiple expansion. So we're getting an 11% free cash flow yield that the company can use to do dividends, do buybacks, but I'm getting little to no revenue growth and pretty much free cash flow growth on $18 billion. So I believe I can see around an 11, 12% annual return minimum on a company like Pfizer, but this is excluding a multiple expansion and excluding any potential drug discoveries or anything that could surprise to the upside on revenue growth, which could massively increase the multiple. The multiple on Pfizer right now is only 8 times. 8 times is dirt cheap. The company traded around 12 times on average, and now trading at 8 times earnings. 8 times is very, very cheap. So I see at least 12%, maybe 13%, up to 13% annual return on Pfizer without a multiple expansion. With a multiple expansion, it could be much, much higher. So I really like the setup over here relative to other stocks in the market, especially with the dividend and interest rates coming down. But of course, we still have a lot of pharmaceutical risks in general, with President Trump wanting to cut drug prices, and you still have a lot of things on Pfizer from the COVID days back in 2020, 2021, and the current administration is not too friendly on COVID vaccines and Pfizer in general. So Pfizer could suffer more from that, and all those things are waiting on the stock. But in terms of the fundamentals, they're really great, and I believe a lot of the bad is priced in. And I think it should likely get better from here if the company can buy back stock going into early to mid 2026. So I still like Pfizer over here. I still believe it's a great opportunity. It hasn't played out too well, but maybe it could potentially play out in the near future. And that's my opinion on Pfizer and my recent analysis. It was not financial advice. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.